Have you ever walked into a dark room, completely pitch black, and tried to navigate your way around without bumping into furniture? It's terrifying, right? You're moving slowly, shuffling your feet, hands stretched out in front of you, praying you don't stub your toe on the coffee table or knock over a vase. You feel vulnerable. You feel blind. Well, investing in the stock market without knowing how to read financial statements is exactly like walking into that dark room. You might get lucky. You might make it across the room without getting hurt, but chances are eventually you are going to trip. And in the world of investing, tripping doesn't just hurt your toe, it hurts your wallet, your future, and your financial freedom. Welcome back to MonsterInvest. I'm your host, Daniel. Today, we are going to turn the lights on. We are going to take the intimidating, boring, gray world of accounting and turn it into a story that is vibrant, logical, and surprisingly exciting. By the end of this episode, you won't just be looking at numbers on a page, you will be reading the biography of a business. You will be able to look at a company and tell if it's a healthy athlete or a sick patient on life support. This is going to be a deep dive. We aren't just skimming the surface today. We are going to master the language of business. Warren Buffett once said that accounting is the language of business, and if you don't speak the language, you can't understand the story. So get comfortable, grab a coffee or maybe a lemonade. You'll understand why I said lemonade in a minute, and let's begin. Now I know what you're thinking. Daniel, I'm not an accountant. I hate math. I barely passed algebra in high school. Relax, take a deep breath. You do not need to be a mathematician to read financial statements. The math involved here is simple addition and subtraction. That's it. The hard part isn't the math, it's understanding the concepts. It's understanding the characters in our story. To explain this, I don't want to start with a massive, complicated conglomerate like Amazon or General Electric. That's too noisy. There are too many moving parts. I want to strip this down to its absolute core. I want to introduce you to a young entrepreneur named Leo. Imagine Leo is an ambitious kid in your neighborhood. He decides he wants to build an empire. He's not just setting up a card table, he's launching Leo's Luxury Lemonade. He wants to sell the best, organic, cold-pressed lemonade in the city. To understand Leo's business, or any business, from a hot dog stand to Apple Inc., you need access to 3 sacred documents. In the investing world, we call these the holy trinity of financial statements. They are: number 1, the balance sheet. Number 2, the income statement. Number 3, the cash flow statement. Most beginners think these 3 things tell you the same story. They don't. They tell you 3 completely different perspectives of the truth. You need all 3 to see the full picture. Let's start with the first character in our trilogy, the balance sheet. I want you to visualize the balance sheet as a photograph. It is a snapshot frozen in time. If Leo's business year ends on December 31st, the balance sheet is a photo of his business taken at exactly 11:59 p.m. on that day. It doesn't tell you what happened yesterday or what will happen tomorrow. It tells you exactly where things stand right now. The balance sheet answers one fundamental question: what is this company worth if we shut it down today? It is built on a very simple equation. You might want to write this down or just tattoo it on your brain. The equation is assets equal liabilities plus shareholders' equity. Let's break that down using Leo's lemonade stand. On the left side of the page, we have assets. This is everything the company owns that has value. But in the real world and on a real financial statement, assets are split into 2 categories, current and non-current. This is important. Current assets are things that can be turned into cash quickly, usually within a year. For Leo, this is the cash he has in his lockbox. It's the inventory, the lemons, the sugar, the cups sitting on the table. It's distinct from non-current assets or long-term assets. These are things Leo owns that he plans to keep for a long time. This would be the expensive stainless steel juicer he bought, the heavy wooden stand itself, maybe a refrigerator. Why does this distinction matter? Because if a company has all its wealth tied up in factories and machines, non-current assets, but has 0 cash current assets to pay the electric bill next week, they are in trouble. They are what we call illiquid. They are rich in stuff but poor in cash. Now let's look at the right side of the balance sheet. This is where the money came from to buy those assets. It comes from 2 places. Either you borrowed it or you own it. First, liabilities. This is what Leo owes to other people. Just like assets, we split these into current and non-current. Current liabilities are bills due soon. Maybe Leo owes the grocery store for the lemons he picked up this morning. He has to pay that in 30 days. Non-current liabilities are long-term debts. Let's say Leo wanted to expand, so he borrowed $500 from his dad to build a second stand. He has to pay that back over 5 years. That is long-term debt. Finally, we have the last piece of the equation, shareholders' equity. This is the magic number. This is what is left over. If Leo sold all his lemons, sold the stand, sold the juicer, his assets, and then paid off the grocery store and his dad his liabilities, the cash that remains is the equity. It belongs to him, the owner. In the stock market, when you buy a share of a company, you are buying a piece of this equity. You want this number to be positive, and you want it to be growing. So when you pull up the balance sheet of a company you want to invest in, look for a few things. Does it have a lot of cash? That's safety. Does it have too much debt? That's danger. A great company usually has at least twice as many current assets as current liabilities. This is called the current ratio. If a company has 2 in cash and inventory for every one of bills due, they are safe. They can survive a storm. If they have 0.9 for every one of bills, they are drowning. Okay, we have looked at the photograph. We know what Leo owns and what he owes, but is he actually making money? The balance sheet won't tell you that. For that, we need the second character, the income statement. If the balance sheet is a photograph, the income statement is a movie. It tells a story over a period of time, usually a quarter, 3 months, or a full year. It answers the question, how profitable is this business? This statement is often called the P&L or profit and loss statement. It follows a logical flow, like a waterfall, cascading from the top to the bottom. At the very top, we have the top line. This is revenue, or sales. It's the raw money coming in the door. Let's say in the month of July, Leo sold 1,000 cups of lemonade at 5 a cup. His revenue is 5,000. That sounds amazing. Leo is rich. Wait, not so fast. We are at the top of the waterfall. Now we have to start subtracting. The first thing we subtract is the cost of goods sold, or COGS. This is the direct cost to make the product. The lemons, the sugar, the ice, the cups. If the ingredients cost Leo 2,000, we subtract that from the 5,000 revenue. We are left with $3,000. This number is called gross profit. This is a crucial checkpoint. If Leo's gross profit is low, it means his product is too expensive to make. No matter how much he sells, he won't make money if the lemons cost more than the lemonade. But we aren't done. The waterfall continues. Now we subtract operating expenses. These are the costs to run the business that aren't directly tied to 1 cup of lemonade. This includes marketing, the cardboard sign Leo painted. It includes R&D, the experiments Leo did to find the perfect sugar ratio. It includes wages. Maybe he pays his little sister to wave at cars. And it includes a very tricky concept called depreciation. Let's pause on depreciation for a second because it confuses everyone. Remember that expensive 500 stainless steel juicer Leo bought? He paid cash for it, but on the income statement, accountants don't let you subtract the whole 500 at once. That would make 1 month look terrible. Instead, they say, this juicer will last for 5 years. So they spread the cost out. Every month, they subtract a tiny slice of the juicer's value. That cost is called depreciation. Ideally, it reflects the machine wearing out. It's a non-cash expense because Leo didn't actually write a check for it this month, but it reduces his reported profit. Okay, back to the waterfall. We take our gross profit, 3,000, subtract the operating expenses, let's say 1,000, and we get operating income. This is the profit from the core business itself, before we worry about banks or the government. Next, we subtract interest. Remember the loan from his dad? Leo has to pay interest on that. Then we subtract taxes. The government always gets its share. Finally, after all those deductions, we hit the bottom of the page, the famous bottom line. This is net income. If Leo started with 5,000 in revenue and ends up with 1,500 in net income, that is his profit. That is the money he can put in his pocket or reinvest to buy a second stand. As an investor, you want to see a history of this number going up, but, and this is a huge but, you also need to check the margins. Net profit margin is the percentage of revenue he keeps. 1,500 divided by 5,000 is a 30% margin. That is fantastic. If you look at a grocery store, their margins might be 2%. They sell a lot, but keep a tiny penny on every dollar. Software companies like Microsoft might have margins of 30% or 40%. Generally, high margins mean the company has a moat, a competitive advantage. It means they can charge a premium price and people still pay it. So we have the balance sheet, the photo, and the income statement, the movie. Are we done? Can we invest now? Absolutely not. We are missing the most honest, ruthless character of them all, the lie detector. This is the cash flow statement. You might be asking, Daniel, if the income statement shows net income, isn't that the same as cash? No, and this is the trap that destroys beginner investors. Profit is an opinion, cash is a fact. Let me explain how profit can be an illusion. Imagine Leo gets a huge order. A local corporate office wants 10,000 cups of lemonade for a company retreat. That's a $50,000 order. Leo delivers the lemonade today. The company is happy. They sign an invoice saying, we will pay you in 90 days. On the income statement, accounting rules say Leo made a sale today. Revenue goes up by $50,000. Profit skyrockets. It looks like Leo is having the best month ever. But check his bank account. Is there $50,000 in there? No, there is zero. He has no cash. Now suppose his lemon supplier demands payment today. Leo looks at his empty bank account. He can't pay. He goes bankrupt. He went bankrupt while being profitable on paper. This happens all the time. It's called a liquidity crisis. The cash flow statement fixes this. It only tracks actual dollar bills moving in and out of the bank account. It doesn't care about invoices or promises. It asks, did the check clear? The cash flow statement is divided into 3 sections. 1. Cash from operations. 2. Cash from investing. 3. Cash from financing. Cash from operations is the heartbeat of the company. It measures the cash generated from selling the actual product. In our example with the corporate order, the income statement would show huge profit, but the cash flow statement would show zero cash coming in. This is a massive red flag. If you ever see a company where net income is going up, but cash flow from operations is going down or staying flat, run away. It means they are booking sales that they aren't collecting money for. It's a classic sign of potential fraud or bad management. The second section is cash from investing. This shows where the company is spending money on its future. Did Leo buy a new stand? Did he buy a delivery truck? This will show up as a negative number because cash left the building. But this is good spending. It's an investment in growth. We call this CapEx or capital expenditures. The third section is cash from financing. This shows how Leo interacts with the capital markets. Did he borrow more money from the bank? Cash comes in positive. Did he pay back a loan? Cash goes out negative. Did he sell shares of his company to investors? Cash comes in. Did he pay a dividend to himself or shareholders? Cash goes out. So how do you use this? You want to find a company that is a cash cow. A cash cow is a business that generates huge amounts of cash from operations, way more than it needs to spend on new machines, CapEx. When you take cash from operations and subtract CapEx, you get a number called free cash flow. Free cash flow is the holy grail. It is the excess cash the company generates that can be used to pay you dividends, buy back stock, or acquire other companies. Amazon for years showed very little net income because they reinvested everything. But if you looked at their cash flow statement, they were printing money. Smart investors saw this. Lazy investors missed it. Now that we understand the 3 documents, let's talk about how to analyze them together using some red flags and green flags. Let's start with red flags, warnings that should make you nervous. Red flag number 1, increasing accounts receivable faster than sales. Accounts receivable is the money customers owe the company, like the corporate order Leo hasn't been paid for yet. If sales went up 10%, but the money people owe the company went up 50%, that's bad. It means customers aren't paying their bills. The company is acting like a bank, lending product for free. Red flag number 2, rising inventory. If Leo's inventory of lemons is growing every month, but his sales are flat, what does that mean? It means nobody is buying his lemonade. The lemons are piling up in the warehouse. Eventually, they will rot, and he will have to write them off as a loss. When you see inventory rising faster than revenue, be very careful. Red flag number 3, changing accounting methods. If you're reading the footnotes, yes, you have to read the footnotes, and the company says they changed the way they recognize revenue, or adjusted the depreciation schedule, watch out. Companies often do this to mask a bad quarter. Great businesses don't need to use accounting tricks. Now let's look for green flags, signs of a monster investment. Green flag number 1, consistent, high gross margins. If a company has maintained a 40% gross margin for 10 years, it means they have power. It means competitors haven't been able to force them to lower prices. Think of Coca-Cola. Sugar water is cheap. They sell it for a premium. That margin is their power. Green flag number 2, high return on equity, ROE. Remember equity, the money that belongs to shareholders. ROE measures how good the management is at using that money to generate profit. If Leo has 100 of equity and generates 20 of profit, his ROE is 20%. That is excellent. The average in the stock market is around 10 to 12%. If you find a company with an ROE consistently above 15% or 20% with low debt, you have likely found a compounder. Green flag number 3, the company buys back its own stock. When a company uses its free cash flow to buy its own shares from the market, it reduces the total number of shares. This means your slice of the pie gets bigger without you doing anything. It's a sign that management believes their own stock is undervalued. Okay, let's synthesize all of this with a quick comparison. Imagine 2 companies. Company A is a trendy tech startup. Company B is a steel manufacturer. If you look at the balance sheet of the steel manufacturer, you will see huge non-current assets, giant factories, blast furnaces, heavy machinery. They also probably have a lot of debt because those machines are expensive. If you look at the tech startup, their balance sheet is light. They might not own any buildings, they rent everything. Their biggest asset isn't a machine, it's the intellectual property and the software engineers, which doesn't always show up clearly on the balance sheet. On the income statement, the steel manufacturer will have high depreciation costs because their machines wear out. Their margins might be low. The tech startup might have huge research and development costs but very high gross margins because selling one more copy of software costs almost zero. Neither is necessarily better, but they are different. You cannot judge a fish by its ability to climb a tree. You have to judge a steel company against other steel companies and a tech company against other tech companies. We have covered a lot of ground today. We traveled from the static photo of the balance sheet through the moving picture of the income statement to the brutal honesty of the cash flow statement. Before we close, I want to summarize the key takeaways for you to carry with you. Here is your cheat sheet. 1. The balance sheet tells you the financial strength. Assets equals liabilities plus equity. It tells you if the company can survive a bad storm. Look for more cash than debt. 2. The income statement tells you about profitability. Revenue minus expenses equals net income. It tells you if the business model actually works. Look for growing revenue and stable margins. 3. The cash flow statement tells you about solvency and reality. It tracks the actual cash. Profit is not cash. Always trust the cash flow over the net income. 4. Ratios are your friends. Use gross margin to measure pricing power. Use return on equity to measure management efficiency. Use the current ratio to measure short-term safety. 5. Context is king. Don't look at numbers in a vacuum. Compare the company to its competitors and to its own history. Is the trend going up or down? Reading financial statements is a superpower. It allows you to ignore the noise of the news headlines, the shouting on TV, and the hype on social media. When everyone else is panicking because a stock price dropped, you can open the financial statements and say, wait a minute, this company has zero debt, growing cash flow, and high margins. The market is wrong, and that is when you make money. Investing is not about gambling. It is about business ownership, and you cannot be a good owner if you don't understand the report card of your business. So here is my challenge to you this week. Pick one company, just one, maybe a company you use every day like Starbucks or Netflix. Go to their website, find the investor relations section, and download their latest annual report. It's called the 10K. Skip the fancy pictures and go straight to the financial tables. Try to find the 3 characters we talked about. Look at their cash, look at their debt, look at their margins. It will be hard at first. It will look like a foreign language, but keep looking. Following the story of Leo, try to find the story in those numbers. That is it for this masterclass episode of Monster Invest. I hope the lights are a little brighter for you now. If you found value in this deep dive, please subscribe and share this episode with a friend who is still walking in the dark. Until next time, keep reading, keep analyzing, and keep investing in your own knowledge. I'm Daniel, and this is Monster Invest.